analyst for Phillip Future Singapore. He'll be talking about gold. Basically what he intends to cover will be the possible short-term risk-off sentiments, long-term US dollar trend, inflation hedge in the longer run. This will be some of the things that Jonathan will be covering on. And without further ado, I will be handing the reins over to Jonathan. Jonathan, over to you now.
Okay, thank you, Sri. Okay, for this section, I'll be presenting to you my gold outlook for 2017, where I'll be using macroeconomics to provide you with a contrarian view on why I am bullish on gold. So here is my presentation outline. I'll first start with three foreseeable drivers for gold prices in 2017. Firstly, there will be possible short-term risk-off sentiment caused by geopolitical developments, after which I'll proceed to expound on the Federal Reserve's dilemma and possible impacts on the US dollar. Lastly, I'll talk about cross-asset cycle analysis, after which I will end off with my 2017 gold price forecast. So let's start with geopolitical developments, where I'll be talking about a possible deterioration of Sino-US relations, as well as the future and viability of the Eurozone. Okay. To recap history, let us revisit how gold prices performed during key political events in 2016. In this example of Brexit, we see gold prices spike up 9% in 5 hours as the votes for the Brexit referendum were counted on the morning on 24 June 2016 Singapore and Malaysia time from 1250 to 1359. Gold prices stabilized after that at around 1320. Now moving on to the US presidential election vote counting period on the 9th November 2016, gold prices started to spike up 5% from 1270 to 11337 as Donald Trump surprisingly led Hillary Clinton in the vote count. But after he was declared winner, he took on an equally unanticipated reconciliatory tone that calmed financial markets. Investors started to reconsider his economic policies and started getting excited on the prospect of his massive fiscal stimulus. This caused a major shift in investor sentiments as they became more risk-on, pushing up US equity and the US dollar. As a result, gold prices tumbled, falling back to levels before the vote count. Now moving on to 2017, a foreseeable geopolitical risk would be the deterioration of Sino-US relations. This has been seen in several heated exchanges between Donald Trump and the Chinese government, ranging from trade, Taiwan, and the South China Sea. Donald Trump's appointment of outspoken China critic Peter Navarro as his chief White House trade advisor does not make the situation any better. After the Brexit issue threatened the integrity of the Eurozone in 2016, more headwinds are expected in 2017 as the Germans, the French, and the Dutch head to the polls to vote for their government. Here are the dates of the various European elections for you to take note of. I anticipate that gold prices may spike up during these periods on the back of geopolitical uncertainty, just as you have seen during the Brexit and the US presidential elections in 2016. For the French and German legislative elections dates, though they are still not confirmed, so what I have posted out here is the tentative period. The political sentiments in the Eurozone have been shifting in favor of far-right Eurosceptic politicians. This shift in sentiment could be mainly attributed to three factors of slowing economic growth, high unemployment, and the many terrorist attacks that have occurred in Europe. In the next few slides, I will introduce you to several far-right parties of these countries and their leaders. So firstly, in Germany, you have Franka Petri and her party Alternative for Deutschland. Over to France, there is Marine Le Pen and her National Front party. In the Netherlands, there is Geert Wilders and his Party for Freedom. Now moving on to my second point, that the Federal Reserve face a dilemma. Firstly, we will explore how Trump's policy could lead to possible stagflation and how the Fed may respond to this and what are the impacts on the US dollar. As Trump's policies are actually still uncertain, these are some assumptions I made in developing my forecast model based on his campaign promises. Firstly, I believe he is going to create a huge fiscal gap based on his twin plans of massive fiscal spending on infrastructure and a general reduction in tax burden. Some sources, such as the Committee for a Responsible Budget, estimate that the cost of his fiscal plans would generate an additional 11.5 trillion US dollars over the next decade. Given his appointment of Peter Navarro and Robert Lighthizer, two outspoken China critics, to be his chief trade advisor and top trade representative respectively, I expect him to be pursuing protectionistic trade policies. Another assumption that I'll make is that the US economy is close to full employment as per the Fed's economic forecast. I also assume that he will be keeping his promises to the American workers for higher wages and more jobs over automation. And another important point to note is that these assumptions will be constantly revised as the latest developments unfold. Okay, based on these assumptions, I expect the US growth to decline while inflation might stay high for a while. Trump's fiscal spending is expected to put upward pressure on the Fed funds rate, and the Fed might be forced to provide additional liquidity to prevent a credit crunch. Given such a massive fiscal plan, debt in absolute and percentage terms are expected to rise over the next 5 years based on my projections. Hence, the Fed might have to accommodate instead of tighten, as Trump's fiscal borrowing plan will put upward pressure on the yield curve. How the yield curve will eventually look like still remains a big unknown, but it is certain that the Fed will be looking to avoid a credit crunch scenario of an inverted yield curve. An important point to note is that the US yield curve has been flattening over the last 4 years as seen in this diagram. So what is the impact on the US dollar? The US dollar may continue to go up with interest rate, but is this sustainable in the long run given the risk of a credit crunch? As gold prices move in opposite directions with the US dollar, we expect gold prices to recover in the longer term after having been suppressed by the recent US dollar rally. Now to move on to my final part on cross-asset cycle analysis. In this section, I will analyze the relation between the three main asset classes of credit, equity, and gold. So first, this is an introduction to our model. There are 4 phases. So we shall start from the first phase, which is the growing phase, where there are low interest rate Equities and credit products are expected to outperform at the expense of gold. Another important feature to note is that earnings will be greater than debt at this phase. The second phase is the slowing phase where there are rising interest rates and debt levels will be greater than earnings. In this phase, equity and gold should outperform credit. Now moving on to the third phase of deleveraging, where interest rates are high with a credit crunch scenario. This is when credit and equity markets will be plunging and there will be a flight to safety for precious metals such as gold. Onto the last phase is the revival phase, where fiscal and monetary authorities will have to embark on stimulus to revive the economy through cutting rates, fiscal spending, and tax cuts. Gold and credit are expected to perform favorably compared to equity should they fall to find a price drop. A question that you may be asking right now is, which phase are we currently at? My view is that we are currently at the slowing phase where interest rates are tightening and gold prices are expected to continue rising. However, an important point to make is that the current actual situation is slightly different from our model, as Donald Trump still wants to embark on fiscal stimulus instead of fiscal tightening. The effect of this anticipated measure is still unknown, as on one hand, it may spark off a credit crunch early and go into the deleveraging phase early, or it might prolong the slowing phase. This would be based on the exact details of Trump's big fiscal plan and how does the US Federal Reserve going to react to the distortions in the yield curve that it would create. So now moving on to my 2017 gold price forecast. My view based on all the fundamentals that I have discussed is that gold prices should touch the 1,300 resistance level sometime this year. Now that I've concluded my section on gold, I will hand over this webinar to my colleague David to bring you through the palm oil outlook for 2017.
Thank you very much, Jonathan Chan. Now that we've covered the portion on our favorite metal, next up we have David, who will be walking you through the opportunities in crude palm oil in 2017. So without further ado, can we have David on, please? David?
Hi, yep. I'm not sure you guys are hearing me. Thank you, Sri, for the wonderful introduction, and also thank you, Jonathan, for the part on gold. So today I'll be just covering on crude palm oil. I'm just going to walk through the audience through some of where do we see the crude palm oil price outlook for 2017. Okay. Can we move to the next slide?
Once again, David, let me switch controls over to you.
Okay.
All right, over to you, David.
Yep. Thank you, Sri. Yeah. So as I was saying, I'm just going to cover on the crude palm oil outlook and where do we see the market for CPO, especially in this year. But before that, I'm just going to go through that the outline that I'm going to present in my topic. So we're just going to go through some of the price dynamics that's happened in 2016. I think it was indeed a tremendous year for some of the traders who trade the market, especially in the year 2016. If you are following the market for quite some time, I think CPO has actually broken a very supportive range. Indeed, it was a good rally, especially in second half of 2016. So where do we see prices in 2017? So we'll go through some of the factors that we will see as a potential catalyst for the market, especially in this year. Okay, I'm just going to touch a bit on demand because I think we have slowly witnessed that the demand for CPO, especially for major markets like China and India, has actually significantly declined over the years, and is actually going to be a medium-term concern. So we're just going to go through some of it later on the slides. The third part of my presentation is going to touch on seasonality, especially in commodity space. If you talk about agri products, whether it's soft grains or or hard grains, I think seasonality plays a very crucial role, and in particular for palm oil as well. So I just want to show you some of the seasonality, whereby it's an opportunity for you to trade in the market for palm oil. Ring currency is a very big factor for the year of 2016, especially on the ringgit Malaysia. And we clearly can see there's a strong correlationship between the ringgit as well as the CPO price performance. So we're going to just touch on this later part on the slides as well. And finally, where is our forecast, price forecast for the year 2017. So you can clearly see from this chart, if you just look at the darker color line, it's actually showing you the commodity price for CPO for the year 2016. It indeed has a strong rally. It rallied from the low of 2,200 ringgit per metric ton to the high of 2,000, almost touching above 3,000 ringgit per metric ton. And if you just look at the yellow line, which is signifying the line for constant commodity index, so if you look at it, clearly there's a big divergence between the palm oil and the commodity index. And clearly, I think palm oil did outperform majority of other commodity basket for year 2016. And the major factor that we can attribute this to is actually mainly due to production. Okay. Now this is just to show you the price dynamics. So you can clearly see year 2015 was a very range-bound trading. So those who are in the market, I think it's pretty much less volatility in the market. But when it comes to 2016, we can clearly see price was as high as 2008. It broke that. It reached 3,002 at the end of 2016. And as of 2017, we're still witnessing the price above 3,000 level. So you can clearly see the CPO price indeed has turned into a bullish phase. And I think majority of these fundamental factors that's actually attributing to this increase is mainly down to production. Okay. Now, I think just yesterday we just had the official release from the crop report from Malaysia Palm Oil Board. So you can clearly see December 16 figures has been very positive. Of course, consensus has mentioned that palm oil stocks in Malaysia will probably be lower than expected. But I think the consensus was a bit bullish. In fact, when you look at MPOB report, month to month, it was actually a positive change. So that actually caused a bit of a cautious sentiment among the market participants. But overall, just look at it, production is pretty much in line trend. Month to month is about 6.4% decline. If you just look at other important stats like exports, it's 7.5% decline. So these are all quite in line with seasonal pattern. However, I think market are paying quite close attention on the stocks level. As long as stock levels continue to increase, I think that could be a cap on prices. Okay. Now, let's move on to the next slide. So here you can clearly see that this is basically the month-to-month production pattern for CPO. So you can clearly see, like I mentioned earlier on in the earlier part of my slides, palm oil has a seasonality. And it has a, I would say, distinct pattern. You can clearly see from the first half of the year, production tend to be lower. And if you just break down month to month, around April and May is where most likely the upturn in production cycle will likely to happen. And usually production will peak around August or September. This pattern is replicated for the past 5 years. Will it be any different in 2017? Personally, I would think that production is pretty much depends on weather and how weather can perform for pretty much for the year. If we discount any weather adversities or if we discount any extreme weather conditions in 2017, I think production pattern for this year will pretty much in line with some of the 5-year seasonal trend. So if you are trading the market, just be cautious around July-August period because that's where production will tend to peak. And you can see uptick in production around March and April. So these are the 2 periods of months that you should be careful. Now, this is just explaining in terms of price performance against some of the previous slides was talking about months where production tend to peak and production tend to reverse on the upside. So whenever the production tend to peak, those are the months or those are the period where prices tend to be well supported. And when periods of production where tend to be on a upside bias or decided to reverse on an uptrend, prices will tend to drop during that particular month. So this, if you just look at the cycle for the past 5 years, it has displayed tremendous seasonality pattern, especially on month-to-month basis. Okay. Now, I think basically 2016 we have saw price dynamics to be very positive. As I mentioned, the main factor is down to production. So you just look at this chart, we've compared 30 years of production data for CPO, and it's very clear that over the years, 2016 was the year that we faced extreme low output in terms of production. Every year was a recorded positive growth, but 2016 was the year where we suffer actually decline in production. Therefore, that explains why prices was actually on a strong rally. Okay. Now, what attribute to this strong rally in production? This strong curtail in production output is mainly down to weather. We have suffered many series of El Nino patterns, which is usually associated with dry weather conditions. And in these dry weather conditions, usually it will affect prices. If you just look at it, there was three occurrences of severe El Nino. One was in 1997, another one was back in 2009, and the latest one was around late 2015. And if you just look at the pattern in terms of output, in terms of index, the oceanic NYMEX index that tracks the severity of El Nino, the 2015 El Nino is pretty much similar with the El Nino that happened in 1997. So therefore, I think the impact is pretty much similar. Okay, now I'm just going to continue, and I'll take the questions later on. Okay, now let's assess the impact when we compare 1997 El Nino and the 2015 El Nino. Back in 1997, the El Nino was so severe that it pushes the CPO price as high as 120%, okay, gains in the market. And if you just look at the 2015 El Nino, which happens around late 2015 to early April 2016, there was a marked increase in terms of prices at least 60%. Okay. So every time when there's extreme weather, be it El Nino or La Nina, El Nino tend to be a bit more reactive to the market. We are expecting price changes to be a bit more drastic. So on average, whenever there's an occurrence of El Nino, price change will probably be between 30 to 45% in terms of CPO prices. Okay. Now, let's estimate in terms of production for this year. This year, we're estimating that production will tend to rise across Malaysia and Indonesia. We can't really predict weather, to be frank, because I think weather is so volatile these days that even I think the best forecasters got it wrong. So I think basically based on some of the estimates that we're getting, we should expect 2016 should be the year of recovery in terms of production. As I mentioned, 2016 was really an abnormal year. We have suffered a very huge decline in production. If you just look at the chart here, I think 2016 was the year both Malaysia and Indonesia recorded for the first time below 50 million tons production for the year. So I think 2017 will be a different scenario. We are expecting production to recover, especially both in Malaysia and Indonesia. Malaysia, we just look at data yesterday that's reported by MPOB. Total output by Malaysia was about 17 million. So we are expecting in 2017 total production for Malaysia will be about 19 million, and Indonesia will be about 33 million. So that will bring us about 56 to 57 million in total. This recovery in production is definitely will not augur well in terms of prices. We should expect prices to soften towards the second half of this year. Okay. Now, so that's in terms of the production picture, the supply dynamics. Let's move on to the demand dynamics, especially when you look at exports of palm oil to some of the key destination countries. China is definitely a big major consumption of palm oil, as you can see from the chart. I've drawn the total volume palm oil exports to China over the years, and also their market share. I think the biggest concern here from this chart is that we are slowly seeing a growing, slowing down market share coming from China, and it's actually a serious concern. Even you look at the numbers, absolute numbers, we are looking at about 4 million tons back in 2011. Seeing that number down to about 2 million now. As of yesterday's numbers, we got about 1.8 million tons for the year 2016. So I think those figures are telling you that China is growing, they're less dependent on palm oil, and probably they're shifting over to other vegetable oil market. If you look at it, this will not have a short-term impact, but if you look at it on a medium to longer term impact, it will have an impact. Okay, because China is still quite a big major consumer market. especially when it comes to vegetable oil. So if we lose this reliance to China for palm, I think the demand is going to be in question. Now, what attribute to last year China's significant drop in demand? I think it's mainly down to rapeseed. We can clearly see some of the action that by local traders. They have been absorbing a lot of rapeseed oil from the market. Even the China authority is also releasing a lot of rapeseed oil to the market, just trying to use some of their rapeseed reserve. And on top of that, I think China rapeseed prices are very competitive against palm oil prices. Therefore, that explains why rapeseed is higher in demand, and that shifts some of the demand from palm oil over to rapeseed. And I think obviously there's one more equation that we should take note whenever we look at China demand dynamics, which is soybean oil. I think soybean oil has always been an oversupply situation, and we can clearly see US exporters are pumping a lot of soybean over to China, giving a good discount just in order to compete with other vegetable oil market. So given these two fundamental factors that's happening in China for the whole year, I think it's without a doubt that China demand for palm oil is generally going to be low. Now, the thing is that the port inventories in China looks relatively low at the moment. Probably in the next couple of weeks, we should see some buying activities to resume just to balance up the port inventories. If you ask us, do we see any significant demand coming from China this year? At the moment, we don't see as such, because we still see rapeseed prices and bean oil prices on China local prices are very competitive, and it's shifting some demand away from palm oil. Now, I think this chart explains all. China growing dependence on soybean is tremendous. You just look at their growth. I think mainly soybean is mainly used for animal feed. When they use more of the soybean to crush it and for meal rather than oil. So with increasing abundance of soybean oil in the market, that's going to give a fierce competition in terms of palm oil, especially when you look at the China market. And in 2016 and 2017 trade year, we are looking at soybean shares in China will continue to increase, and US and Brazil, the two key supply markets of soybean, will continue to export over to China. And with growing dependence on soybean, I think that will really put palm oil demand into question. Okay. So this again explains the fact that China is slowly moving into soybean oil just because of the demand for soybean meal, and it's mainly used for animal feed. If you just look at some of the trade data, some of the economic numbers from China, private consumption has been robust, and that explains why internal consumption in China has remained very strong, very resilient, and therefore the demand for soya meal will continue to increase, and that explains why is the need for China to demand so much of soybean. Okay. Now, so that's on China picture. Another major buyer market is actually India. China and India is actually constitute about 30 to 40% of Malaysia exports. If you just look at in terms of totality, China and India constitute roughly about 40% of total exports for both Malaysia and Indonesia. So China and India is regardless the two big markets for the palm oil market. But as I mentioned in earlier slides, China reliance on palm oil is continue to decline. But if you just look at India picture, it's a bit on the contrary. India has actually grown their market share in terms of palm oil over the years. Their consumption of palm oil has been quite fairly balanced on average. We are also seeing that in the next couple of years, India will continue to increase their consumption of palm oil. At the end of the day, I think it's a matter of price. If you just compare soybean prices and palm oil prices, although there's a recent rally, is still pretty much competitive. And I think India is a market where palm oil will fit best, although there's in competition with local oil seeds in India. But I think palm oil will sit very well in the Indian market. So if you can look at this chart, I think India has majorly grown their market share, and in terms of their total volume has also increased over the years. What to take note is that 2016 was a year where both markets, China and India, faced a decline year-on-year basis, and that's why the production picture may look rosy, but the demand picture doesn't really paint a beautiful picture. So I think these are the things that we going towards 2017. We need to take note on some of the key areas that are, we'll say, growing concern. Okay. Now, so that's in terms of supply and demand dynamics. I'm just going to move on to relationship-wise between palm oil and other commodities, especially crude oil. I think whenever we argue on crude oil and palm oil price relationship, there's always a question on biodiesel, or we call it alternative energy. I think this debate will always continue. I think the current debate has actually grown because of the rise in crude oil prices, as we've seen crude mineral prices. If you just look at the chart, I think palm oil has also rallied, and they have actually closed up the gap between the crude mineral prices and palm oil prices. So if you just look from the biodiesel producer point of view, there's not much incentive for biodiesel producers to produce even more, because the gap between crude mineral prices and palm oil prices has actually significantly narrowed. Moving forward, the crude oil ban between the palm oil price and the crude oil price may provide a support, but as long as crude oil doesn't fall to a certain level, the demand for biodiesel will still be there. Of course, given that recently in US there's a biodiesel blending credit, and that actually support the market a fair bit. But moving forward, as long as crude mineral prices can remain at a certain level, and it's very supportive for palm producers to produce more biofuel, and it will continue. So palm prices in a way will be supported as well. But what's concerned is that the gap between the crude mineral prices and CPO prices is actually quite narrow. Moving forward, if the gap continue to narrow and in fact turn to be negative, there's not much of incentive for biodiesel producers to continue to produce. Okay. Now, this is just to show you some of the premiums. Okay, like I mentioned, once the gap between mineral prices and CPO prices continue to narrow, there's actually not much incentive for biodiesel producers to continue to blend, unless there is a mandate from the government. If you talk about discretionary blending, usually it's very sensitive to how crude mineral prices are. So at current level, it's still a bit of incentive, but you have to take note that CPO prices is actually on a rally. So as long as CPO prices continue to be at this level and the gap is getting narrower, I think the incentive will slowly diminish, and therefore there's not much incentive for biodiesel producers to continue to produce. So market in a way will slowly readjust itself towards the medium term, but in the short term we should see a bit of lesser demand in terms of discretionary blending if crude mineral prices were to come down or CPO prices will continue to rally. Okay, now there's also another significant relationship whenever you trade the palm oil market, or you want to assess the palm oil market, and one of that relationship is actually the relationship between soybean oil prices with CPO prices. There's always a premium between soybean oil and palm oil, and that premium at current level is about $40 US per metric ton. On average, it should be about $100 US. So we are looking at whenever this premium gets narrower, it's actually not so supportive for CPO prices. In other words, when this premium gets narrow, it's signifying that the CPO prices is actually getting very expensive, and it's making it less competitive to soybean oil. So market would tend to readjust itself, whereby CPO prices will have to come down to make it more competitive, and soybean oil will have to go up, okay, to make it to readjust back its premium. So because on the 5 years average, the premium should be around $100 US. So at current juncture, we're looking at a premium at about $45 US. We reckon it will not be sustainable in the near term. We reckon there will be a self-adjustment in the market towards the medium term. So we should expect prices of palm oil to soften a fair bit, or bean oil prices to rally a fair bit to balance up the premium. Okay. Now, as I mentioned earlier in the slides, seasonality plays a very important role. Indices do have a season as well, but when it comes to commodities, I think seasons are very important. If you're a trader, you need to know when or which are the particular month that is weak, or which are the particular months that is strong, because most commodities display a very recurrent seasonal trend. Obviously, there's a lot of other factors that affect commodities in general, especially prices. Like I mentioned, weather is a significant factor. But if you discount all these weather abnormalities or any other factors and just look at pure price patterns or pure fundamental patterns, you can clearly see certain months are very strong months for a particular commodity. So in this context, what I did here was to show you a 15-year seasonality cycle for palm oil. So you can clearly see some of the red boxes and green boxes are telling you some of the months that is negative and some of the months that's positive. So if you see a green month, that means it's a month-to-month positive. If you see a red month, that is a month-to-month negative. So if you can look at the table, the months that are very negative indeed are June-July period, and it's actually coincide with the production pattern that I mentioned earlier on, which I illustrated. June-July is probably the period where production tends to be the highest, and therefore stocks are generally going to be high as well, and it's going to be negative for prices. Okay, and if you look at it, months that are very strong for CPO are usually November and December, because usually it's a year-end period, and towards the year-end period, production would tend to be very low. It can be naturally due to shorter harvesting cycle, and during this period of time, prices will tend to be on more of the positive side. Okay, and these are all coincides with also your stocks level. If you track this table or this pattern with your inventory pattern, it's very similar. Okay, so if you are a trader, you need to know which are the months that are strong months for CPO. Especially your October, November, December are your strong months in CPO, and you need to know that which months are the weak months for CPO, which is usually June, July, August period. Okay. Now, here comes to my last part. Now, this is what I did here was actually to show you the chart performance, price performance on daily basis for CPO market. This is based on Fibonacci lines. If you just look at how the price is reacting for the past couple of weeks, I think the major support is major resistance is looking at about 3,200 ringgit per metric ton. If you just look at some of the explanation that I just explained, especially on production pattern and some of the demand factors, we still expect this current rally to sustain, and in fact, we expect prices to retest again the 3,200 psychological resistance. If we cross that, we are most likely to see prices to hit to 3,500 ringgit per metric ton. We do see a massive support over at about 2007. If it does break down that, I think it's a reversal in a major trend for CPO. We don't see that happening at least for the first half of 2017. Sorry. Okay. So in conclusion, just to wrap up some of the things that we just discussed on the palm oil market, I think declining China imports is mainly due to influx of rapeseed supplies. How do we see this pattern to continue? We do expect this trend to continue for the rest of the year, unless palm oil can regain its competitiveness compared to other vegetable oil. Then with that, we should see a bit of increase in China demand for palm oil. If you talk about production recovery, we reckon production recovery should kick in around second or third quarter of this year. And usually when production recovers, it's usually in double digits. So if you just look at figures as posted by MPOB yesterday, it was merely a single-digit decline. So we should be very cautious if, let's say, we should see a month-to-month increase on a single digit, because usually when we recover from a super El Nino, the recovery period is going to be very drastic. And once we see a double-digit gains in production, and that should be the time where we should be very cautious with the market. Okay, like I mentioned, we are looking at both Malaysia and Indonesia recovery production in terms between the region of 5 million tons for the year of 2017. Okay. For those who are trading the market, I think ringgit has been a very important major play in recent weeks. As long as the continued weakness in ringgit, Malaysia will provide a bit of support for palm oil prices, and therefore I think we reckon prices will continue to be supported as long as the ringgit Malaysia remains weak in the near term. Okay. However, there's a few factors we are quite cautious. First thing is that the demand picture from China. The second thing is actually the narrowing premium between the palm oil and soybean oil. we noticed that the premium has been staying for this range for quite some time. We reckon that this range will not be sustainable in the near term. We believe that this premium will go up back to the long run average of $100 per metric ton, and with that, I think palm oil prices will have to be softened, or soybean oil prices to rally, okay, in the midterm. So with that, what's our view on prices? Our price view for at least the first quarter looks likely the price may test again the 3,200 psychological resistance, and we possible will hit once if that psychological resistance is being broken. We are possibly heading to 3,500 before or reversal thereafter. Reversal are likely to be seen probably in the second half of the year. Okay. So with that, I'll conclude my part. I'll hand it back to Sri.
All right, thank you so much, David. Actually, while you still have the mic turned on, you have a couple of questions from Shuin Yi Lee. Do you want to pick them up right now?
Yeah, sure. What's the question, if you don't mind, Sri?
Sure. The first question: how do you see current weather in Malaysia and Indonesia, especially palm oil plantation areas?
Okay, thank you for the question. I think that question is a very good question. Like I mentioned previously, I think weather is very hard to forecast. If you just look at a year or two, weather predictions are usually 80 to 85% accurate. Now you're talking about 70% accurate. So weather is a very unpredictable factor. Based on current weather conditions, we have passed El Nino. Usually, El Nino impact will come about a lag period between 12 to 24 months if it's a super cycle. So indeed, we witness a super cycle. So we should expect palm oil production to recover easily on the second half. I think current weather are not showing you any signs of anomalies. We don't see any signs of El Nino coming back again or La Nina in the picture. So weather at this point in time still remain fairly normal, unless otherwise when some of the reports from Australia Meteorological Weather Board are showing you some extreme weathers are developing, then probably our forecast or even our predictions may change. Yep, Sri.
All right, we have one more from Jun Lee. Recent months, export to India has decreased. Is it only because of cash banning policy, or are they switching to another oil?
That's a very good observation, especially on the Indian market. I think the recent policy on the cash monetization in India did have an impact, especially on the palm oil market. As to whether that impact will still continue to extend, we don't think so, because there is only an immediate impact. I think over the longer run, the bigger picture of India is that I think competition for palm oil in terms of local Indian space is getting quite aggressive. In terms of other oilseed prices matching up with palm oil prices. Even palm oil refiners in India is finding it very hard to make it profitable because of the small margin they are earning, which means that they don't have much incentive to import palm oil into the country. They have more incentive to use local oilseeds, and with that, I think if this picture continue to paint in the longer run, I think a demand from India could be in question as well. Sri, back to you.
All right, thank you so much, David. Okay, next up we have a question on gold. Jonathan, we have a question from Seng Yao Lee. The question is, what type of relationship among US market or US dollar, and gold do you see in 2017?
So for 2017, right, my view is that as per my previous diagram that I showed on the cross asset cycle analysis, right, I believe that gold prices will be going up for 2017, even as US equity prices go up. Given that I believe that the equity market's already at the late stage of its rally cycle. As you have seen, the equity rally has gone on for about 8 years already. With regards to the US dollar, right? Generally, gold and US dollar have an inverse correlation. Yeah, so that's the correlation for like the US dollar.
All right. Thank you very much, Jonathan. Okay, we have another question on gold. Okay, other than the dollar index, what other elements that are directly affecting gold or USD or the USD index?
Okay, as you can see from my presentation outline, right, I have mentioned that there are three foreseeable drivers. So the second point is the US Federal Reserve's dilemma. So this is what drives US dollar. So
sorry, Jonathan, do you want me to provide you with the slide controls?
Yeah, sure. Go ahead. So as you can see in the presentation outline, okay, so as you mentioned, the US dollar index is under 0.2, where is what the US Federal Reserve control. So the other two factors are the risk-off sentiments created by geopolitical issues. Like you have seen what has happened in 2016, such as the Brexit and US presidential elections. Then the other thing to consider is a cross-asset cycle analysis, as because gold is an investment tool, right? It's how investors decide to allocate money between gold prices, between gold assets, bonds, and equities. And the US dollar is just a medium of transferring wealth in between all these different asset classes.
Jonathan, we have a request for you to just show us the cycle phase chart again. I believe
Okay,
that's your third section.
Yes. Yep, here you go.
For those keen to have a closer look, if you have any questions, feel free to send them in right now. We're really enjoying the questions that you're sending our way. I'm sure our analysts are very excited to receive them as well. We do have time for a couple more questions, so feel free to send them our way. All right, we have a couple here. The question is, what do you expect from Trump press conference tonight and the impact on the US dollar? Will it be significant? Your thoughts, please, Jonathan.
So for me, what I'm expecting from tonight, actually I'll be mainly expecting him to be continuing down his usual policy stance, such as fiscal stimulus, hopefully not trade protectionism, but there's a very strong possibility because as you have seen, he has appointed a few China critics to his White House Advisory Council as well as in his administration.
So that's Johnson's view
And
on
another
what.
thing is to
Yeah.
note is also the whether will he say anything to offend China or anything of that sort. Yeah.
Thank
But
you,
it's hard to
Jonathan.
say.
Yes, Mr. Trump has that effect, doesn't he? All right, one more on Mr. Trump himself. Mr. Donald Trump will be president of the United States on 20 Jan 2017. What will be the impact on our regional countries, and will it be favorable for us? This is asked by Mr. Gary. Jonathan, do you have any thoughts on this?
Actually, I think the main impact on Trump's presidency on our region is mainly what is his stance on trade. Because I think the greatest threat to us is protectionism. Should the US become protectionistic, we as a region would suffer from a drop in trade, and this would affect our economies. Yeah, but still hard to see whether he will actually carry out these protectionistic policies. So I think we should still stay tuned and watch out during his first 100 days in office.
Yes, everyone's keeping a close eye on the first 100 days. One more for Johnson before I let you go. Will India cut the import tax on gold, which will boost the gold price? That's from Mr. Cheng Bong. Johnson, do you have any thoughts on that?
I do not foresee India cutting the import tax because I think the government is trying to restrict on the gold imports. Because I even heard rumors in December that they were even contemplating a gold import ban. And given the use of gold as a medium of money laundering and corruption, I think the government is more particular on cracking down on on restricting gold imports through taxation.
All right, thank you very much, Johnson. David, we are not gonna let you go yet. We have a couple of questions for you. Okay, the first one will be from Kun Ho Teo. By looking at the seasonal table that you have presented earlier, you mentioned that months of June, July, August will have higher production. In terms of CPO contract month, which contract month that usually traders short, which contract months typically are the months that traders will be shorting? You know, would it be April, May, June, or the actual month of June, July, August that has a higher production? Sorry, David, come again?
Yeah, hi Sri. Yeah, that's quite a good question. You don't mind? Can you just pass me the control of the slides as well, so that I can show the audience?
Sure, just give me a second. Giving you the reins right now.
Okay, thanks, Sri. Yep. So the question on which particular month to short, I think is if you just look at in reference of this table, June, July is usually the period of negative periods. Usually you do because in CPO market, the most active months is usually is the third month, and if when it comes to June, the spots months in June, usually you have to do August or September contract, with reference to the particular spot month, because of the nature that CPO active months are usually in the third month's contract. Yep. Any more, Sri?
All right. Yes, we have a few more for you. Okay. We have one from Mr. Gary. In the long-term run, will there be movement for ringgit going up, going down, or will it be pegged soon?
Wow, this is a very tough question. But before I answer that, I have to emphasize the disclaimer on the earlier part of every presentation, and especially on this question. If you just look at ringgit, and I do see one of the question was posted was about what's my price forecast for ringgit when I mentioned that the CPO price forecast at 3,005. I think our view on ringgit, in particular for next couple of months, will be still on an upward bias. We are looking at a ringgit to reach at least 465 to 470 level, first or second quarter. Continue depreciation of ringgit against the US dollar, and I think this in fact will be very supportive for market. Therefore, I think it supports our forecast to say that CPO prices would climb from current levels to test again the 3002 and in above the 3002 in at least the first quarter or second quarter of the 016. Back to you, Sri.
All right. We're gonna address just two quick, very quick questions before we end the session. We have one from Twin Yi Lee. If you notice put options open interest in July contract, it's incredibly high. Is that right to use that as a reference?
Sorry, Sri, could you repeat the question again?
Sure. Okay, the question is from Chun Yi Li. Put options open interest on July contract is incredibly high. Is that right for Yi Li to use that as a reference?
Yeah, thank you, Sri, for the question. I think it's very hard to just deduce on the activity on the options market to reach a conclusion. But generally, during that kind of period, when it's a low period, whether it's in the options market or futures market, people tend to short. So that explains the increase in the put options. But again, options contracts can be also strategy-wise. They can do between inter-months. So they can be short 1 month, but they're particularly long on another month. So it doesn't really give a clear picture. We can't just use that as a basis of reference. Using put options as a basis of reference, there will be other couple of factors that we need to observe and look at. Back to you, Sri.
All right, thank you very much, David. One last question. How long is the duration of a cross-asset cycle? That is from Mr. Tan.
I think that's reference to Jonathan, in particular gold, or you talk about palm oil?
I'm guessing it's with reference to your crude oil, and you compared the palm oil with soybean, right?
Yeah. Okay. If you talk about cross assets, relationship between cross assets, or the duration of relationship between both asset classes. Could you repeat again, Sri, your question?
Yeah. The question is, how long is the duration of a cross asset cycle?
Okay. So I'm just going to try to tackle that question in reference to palm oil to other asset classes. In particular, you talk about, for example, let's say crude oil. Okay. If you just look at the table, the chart here, there'll be certain cycles or period of time where both asset classes are moving negatively, moving inverse. There'll be certain period of time where they're actually moving together. Palm oil is very unique, has a very unique behavior. If you are trading the market and you want to use cross asset classes as a reference to trade palm oil, you have to be very cautious because there's a certain period of time whereby certain asset classes have significant relationship over other asset classes. For example, when you trade, those who are trading in the palm oil market, before ringgit touches 450 or rather 430 level, it was not a very significant play when you look at currencies. If you try to trade currencies, ringgit Malaysia against palm oil, most of the time you get it wrong because there's no direct linkage between both of the asset classes. But if you look at the current scenario now, ringgit is almost touching 450 level, and if you just look at how it moves against the palm oil, it has a very strong correlationship. So it all depends on how or which other factors is actually playing a very important role. Soybean oil in general is supposed to show a very strong correlationship, but at certain times, one of the asset classes, or rather most of the time, one of the asset classes like palm oil will pretty much lead that kind of relationship, whereby you can clearly see palm oil is giving the direction and soybean oil to follow. So it really depends on which particular scenario you are in. As for now, I mentioned, I think the currency play is playing a very significant role.
All right, thank you so much, David. Jonathan, would you like to add comment on the question of the duration of the cross asset cycle? Do you have any thoughts on that?
Okay, Sri, can I get back control of the slides, please?
Sure. Just give me a second.
Okay. So the duration of each phase, right, actually can vary from 1 year to several years. So right now, as I've mentioned, that we are currently in the slowing phase. But the thing is that I don't know how long we'll be stuck in this phase because we still have to see how what exact policies does Donald Trump actually going to implement, and how the Fed is going to deal with it. Because as I mentioned, if Donald Trump does not do as much fiscal stimulus as he promised, and the Fed actually raise rates faster, right, we might actually go into the deleveraging phase a lot faster. So there is no fixed duration. It's dynamic. It can change based on different situations. So the thing about this cross-asset analysis cycle analysis, right, is that it's just a framework and there's no hard and fast rule. Just use it as a rule of thumb.
All right. That wraps up our lovely live webinar today. I think the audience have been exceptionally wonderful. If you have any other questions, do feel free to send them to futures@phillip.com.sg. If you have questions specific for David or Jonathan, we will reroute them to their respective analysts to get in touch with you. Or you could just stand by for 1 to 2 days when we send our emails to you with a link to the recorded webinar for you to revise what we've covered today. And if you have pressing questions that you want answered right away, just feel free to reply and we'll get them addressed by our wonderful analysts. All right, till the next webinar, have a good night and thank you for joining us today. Bye-bye.